Morning, everyone. So my job title, equity strategist or investment strategist, sounds a bit fancy, but it's just really an economist with a commercial bent. And incidentally, I started my career in the hospitality as well. I was a dishwasher working at Clarendon Park with people on day release from the local prisons. So I wasn't any good at it either. So I want to talk about three things today: interest rates and the Coutts' view on interest rates, our view on the UK economy, and then finally something on commercial and residential property, because I know both from a commercial perspective and your personal perspective that's probably quite important. But the first thing is our interest rate expectations. This rather complicated looking graph is what the traders use, is how to understand the traders' perception of where interest rates are going to go. So the sort of rather faint gold line is where they expected interest rates to move this time last year, roughly, and the dark line is where they expect interest rates to move today. So you can see they've really shifted forwards their interest rate expectations. This is for two reasons. Firstly, the tapering in the United States, so the scaling down of quantitative easing, and secondly, an improvement in the UK economy. So the economists expect, or the traders expect, the first interest rate hike to happen at the start of 2015. Now, Mark Carney has been, I suppose, fairly ambiguous about when he expects the first interest rate hike. It was roughly 2016. Now, it's quite vague, but we expect it probably Q2 2015 to be the first interest rate hike. We don't believe this is the start of quite an aggressive interest rate hike environment for quite a few reasons, which I'll go into. The first of which is inflation. So a lot of people have been talking about quantitative easing and how it could be very inflationary. And we haven't seen any particular evidence of that. One of the big reasons, though, why inflation hasn't really aggressively picked up is we've been importing deflation. And in that, I mean, importing, how do I put it? The UK currency, the sterling, has fallen 25 to 30% since its peak to trough. And therefore, we did import quite a bit of higher oil prices. A lot of the gasoline, for instance, is priced in dollars. And so it meant things were a lot more expensive. But because the currency has appreciated, the cost, as you all felt it, for petrol has decreased slightly. So it's unlikely, we believe the sterling will increase in value, that we see strong inflation. The other important point that I'm trying to make here is about broad money supply, or in essence, bank lending. And it's still negative. It pipped, this is a slightly old chart, it pipped above the positive mark recently, but it's dipped below zero again. So this loose monetary policy that we have, low Bank of England rates, is not necessarily transmitting fully effectively through to the economy just yet. And for that reason, it's unlikely that we'll see significant inflation. So that's one reason why it's unlikely that Mark Carney will hike interest rates aggressively. There are some sort of signs of positive lending. So if you look in the small to medium enterprise, this is the data taken for the Bank of England, the trend there is upward. The most recent data, we saw 600 million fall in lending to small businesses. But it is picking up over time. The trend is intact. There are some key problems, and I think I talked about this transmission mechanism of loose monetary policy into the real economy, particularly smaller businesses. And part of the reason why we haven't seen it really full-blown lending really increase fully for smaller businesses is because banks, they're in balance sheet repair mode. It's very difficult to gauge at what point do banks get out of balance sheet repair mode. We keep on getting nasty surprises, the PPI scandal, various fines for trading with Iraq and Iran, etc. The list just grows and grows. But one of the ways to gauge this is to look at the loan loss rates from peak. And in this kind of crisis, in this kind of financially led crisis, you tend to see loan loss rates from peaks fall around 10%. Now, in the United States, we've seen loan loss rates from peak around 12%, so you could argue that their banking sector is roughly fixed. In the UK, we've seen around 8%. In Europe, we've only seen around 3.5%. So the UK is nearly there. And once they have really properly repaired their balance sheets, then they'll start lending again. And this is a big challenge, I think, for banks at the moment. Another reason why interest rates stay low is household debt to disposable income is still 135% in the UK, above that of the peak in the United States. Now, Mark Carney is very aware of this. This is really the zombie household debt problem. So one interest rate hike will mean that a certain percentage of people will fall into debt arrears on their mortgages. Now, the Bank of England has done some work on this, and it's roughly for every 25 basis point, a 0.25% interest rate hike, you'll see about 1% of people fall into mortgage arrears. So it's very challenging, really, for Mark Carney. If he does, let's say in Q2, as we expect, a 25 basis point hike on interest rates, it will be quite hard for him to hike any further unless we have a real inflation problem. And finally, I'll just really, on the sort of, not on interest rates, more on the UK economy, I wanted to talk about wage inflation, which is so important for the UK economy. Around 60% of GDP is consumerism. So if people feel they have more money in their pockets, they will start to spend it. Now, for the last 5 years, wage growth has tracked below that of inflation. So as I'm sure you have all felt in the hospitality industry, people have less money in their pockets. But for the first time in 5 years, we have seen, I think it's 0.1% of wage inflation, real wage inflation. That's above inflation itself. So that's a positive sign. But this chart really masks a real mixture of segments of the economy where there is proper wage inflation, where there isn't. So if we look at the private sector, for instance, this is taken from VocaLink data. What they do is they take the top 350 companies in the UK, and VocaLink does a lot of the transactional payments. And from that, you can see how much people are actually being paid, put into their pockets. And if you adjust this for inflation, which I've done here, you can see it's positive and has been since really the start of 2013. And that's perhaps part of the reason why the UK economy is improving for now. But if we delve a little bit deeper and look into various segments of the economy, there is a clear laggard here and a clear winner. It's the manufacturing industry where we're seeing a big real increase in salaries. But the public sector is the sector that still really is falling behind in terms of real salaries. And unfortunately, it's likely the public sector will remain quite subdued for some time. It's a rather depressing looking chart here, but if we add up all the debt for the UK, so that of households, corporates and government, it totals around 280% of debt to GDP. Now, you can grow your way out of that problem, but we think the government will responsibly manage down this debt issue. One of the benefits, I think, the UK has compared to, say, the rest of Europe, is we're not in the straitjacket of the euro. So if things really do hit the fan, then Mark Carney can step in and cut interest rates further, or I think of some more imaginative lending policies, such as the funding for lending scheme. And that is the key difference between us and Europe. We're not in the straitjacket of the euro. We have this manoeuvrability. Governments, though, when they have large debt problems like this, like the UK when they came out of the Second World War, they had a significant debt problem. The way they manage it is they inflate their way out of the debt problem. I'll just go on to a few slides because I think this is quite an important one. This is something to all our investors, our clients, we highlight. If you were to stick £100 in a bank account in 2007, your real £100 now, that is after taking into account the rising cost of things around you, would only be £93. So this is, in essence, what they call financial repression. The government is taxing savers. The way they do that is by ensuring that interest rates always remain below the rate of inflation. And if I just flick back. But there are some slightly more positive things. The government budget balance, so that's revenues minus spending, is improving. The UK is a little bit of a laggard here. The most recent data, which is not reflected in this chart, shows a bit of an improvement in the UK. But I think across the board for US and some key countries in Europe that have had big debt problems, the general trajectory for the government budget balance is rising. So we're quite encouraged by that. And also, one of the most important leading indicators for any economy is the Purchasing Managers Index. That's a survey that just questions purchasing managers within various industries to say, are they buying right now or are they being more cautious? And after the financial crisis, we saw a big rebound in this optimism. When it's above 50, they're optimistic, by the way. And then when we had what we call the debt workout issue within Europe, namely Greece, corporate optimism really took a hit, particularly obviously in Europe. But since then, since this issue in Europe is slowly being resolved, we've seen a big pickup in corporate optimism, and that tends to lead to a pickup in corporate earnings. Back to this chart again. This idea that interest rates will remain below the rate of inflation has had a big impact on investors. And this is consequently why it's so important for the housing market and for the commercial real estate market. We have countless number of clients saying, I'm fed up of getting 0.25% interest rate in a bank. I need to get some income from somewhere. And so it's really changed their psyche. They've realized that they can't get it in the traditional safe haven assets. So cash, in 2007, you could achieve 6% in somewhere like iSave or Bank of Cyprus, maybe. But you see now it's obviously fallen quite significantly here. And if you go up the scale of risk, so from the left to right on this chart, government bonds, gilts, for instance, are more than half the yield they were. So that's an expensive risk-free asset to buy right now. And it's only when you go to things like high-yield bonds, which is really, if I'm honest, a banker's phrase for junk bonds, where you start to get yields that are quite attractive. And you have to go to, for instance, emerging market governments to find really high yields. The only place where we've seen yields grow is in equities, stocks and shares, and commercial property. And the nice point about equities and commercial property that the fixed income market doesn't have is it's positively correlated to inflation. If you have strong inflation, fixed income assets tend to depreciate quite significantly. And so you get some form of protection for that. And investors know that, and that's why we've seen quite a sort of strong appetite for commercial property, certainly from our clients in prime real estate London and outside of London. And that's why we've seen very strong rally in say, the FTSE 100. Slightly changing the subject here, just onto housing affordability. I was doing some numbers a while ago looking at the Halifax house-to-price earnings ratio. So at the moment, it's a number much touted at the press. Halifax says that your house-to-price earnings, you need roughly 4.5 times income, or the average is 4.5 times income to your mortgage. So that's a pretty high number. When I started looking into the Halifax numbers, I noticed it's only male income that's in this calculation. So I stripped this all back, and I managed to get data going back to 1955 and included female income into this, because it's obviously quite an important part of household income for quite a few years, actually. And the sort of lighter grey line is my calculation, which tracks the Halifax, but it says the house-to-price earnings ratio is not quite so high as the Halifax states it is. Also, I put in a trend line here because the general trend is for house-to-price earnings ratios over the years is to have rise. Now, this is partly because of the mortgage market liberalisation in the 1980s, but also, unfortunately, the Council of Mortgage Lenders don't give me data going back pre-2000, but the buy-to-let market has risen from 1% in 1999 to 13.5% today. So it's a very large part of the market, and part of the reason why the house-to-price earnings ratio will probably remain quite resilient. And people will just have to get used to paying more for a property, particularly when there's a fundamental supply problem in London and other sort of larger cities around the UK. One, I suppose, word of warning in the housing market is this is a rather complicated-looking scatter plot. It's just effectively, if you look at the house-to-price earnings ratio, that's on the x-axis, on the horizontal axis. And look at then, see over the years, going back to the 1970s, what would be your forward house price return? Now, for instance, at the moment, it suggests, this is a fairly reasonable, accurate regression here. You can see that at we're actually at 4.1, not 4.4 times. You would roughly get about 3% for 10-year forward annualized returns in the property market. So we've been experiencing recently, I was just picking out the stats actually on UK housing market. In London, for instance, housing market's risen 18% over the last year. In the north of England, it's 5.8%. So the housing market isn't in malaise at all, really. In Scotland, 7.6%. In the southwest, 7.3%, and in Wales, 5.2%. So clearly, London is a winner here, but it's prevalent across the market. But my point here is that because our projection is that housing prices at current house price earnings ratio will be about 3%, we're probably going to experience some sort of boom and bust. We've got strong house prices now. It's a typical economic cycle that we'll probably experience. And then finally, just because I'm an investor, I wanted to forewarn you about what tends to happen to stocks and shares when we get our first interest rate hike. The markets tend to preempt it, tend to expect it, and you tend to get a decline of around 6%. But then it's almost sell on the rumour and buy back on the news. So once the interest rate hike happens, you tend to get a pickup in equity markets afterwards. Now, this is because investors tend to, when you get the first interest rate hike or the news of the first interest rate hike, there's always a question as to can the economy sustain it? And there's always that period where they're not sure. So we have gone from a stimulus-led economy, that is quantitative easing really propping up the economy, and now we're transitioning to an economy which is really self-reliant, more reliant on growth. And the markets tend to have a bit of a wobble. So when we get the first interest rate hike, we might see a little bit of a wobble, but it does tend to recover, as long as the policy that the Mark Carney makes is the correct one. And so far, it seems he's on the right trajectory for policy. And that's it from me. Are we to take questions now?
Great, thanks, James. Do we have? We've got Accor apprentices that have mics on, so we can, if there's any questions in the audience, we've got a few minutes for questions. Delighted to take any while we've got such a great expert up on stage. So thinking of, if you've got a question, I'll just lead with one. Everything seems rosy, doesn't it? It's all very positive. It's, I mean, although probably best to sell shares in the first quarter of next year and then buy back it again.
Yes, maybe.
Okay. But is there one thing that is a real issue that you think will impact, could impact the economy going forward? And I'm thinking specifically here of Scotland and the referendum and how that might play out.
So if we look at, one of the indices I showed you was the Purchasing Managers Index. That's the corporate sentiment, corporate optimism. And politics have had a massive impact on corporate optimism. And part of the reason why a lot of CEOs have decided not to hire that extra individual because they're unsure about the political landscape. And for us, the Scotland referendum really complicates things. Let's say, for instance, hypothetically speaking, Scotland becomes independent. Labour would lose 40 seats in the government, but they'd still come into the election in 2015 being representative of the UK government. But then come 2016, when Scotland officially becomes independent, it would lead to, I suppose, are they valid? Will we need another election in the UK? And I think there's quite a lot of election uncertainty, particularly if Scotland becomes independent, and that, I think, could really rock corporate optimism. So far, particularly when it comes to Cameron's statement about 2017 referendum, we haven't seen any evidence that it's really dented corporate optimism too much. Particularly Nissan, I think, came out quite shortly after Cameron's statement about a referendum on EU membership. They sort of installed a new factory in the northeast. But that's our one concern. There's quite an uncertain political landscape. If you look at the polls for the Scotland referendum, only about a month ago, they were 1% in lead for the no vote. I think they're around, depending on which poll you look at, around 13% now. So it seems to waver quite a bit. Might take just a few more showings of Braveheart in Scotland to sort of persuade people otherwise.
So what's your view? What's going to happen?
We're vigilant about it at the moment. We're not staking a claim to any particular view at the moment. It's like many hedge fund managers in 2011 decided that Europe was going to break up. It was a wrong idea. They were wrong. And we don't want to fall into that trap. We're closely watching the polls. We will, certainly from an investment perspective, we will we're sort of hedging our bets at the moment.
Okay, so you're hedging your bets. What about the audience? So raise your hands if you think Scotland will become independent. So raise your hands. Come on. No, not many. So who thinks that it's going to stay part of the UK? There we go. So you've got your answer.
Yes.
Perfect. Do we have any questions from the audience? I think we've got time for one more question.
There's a lady at the back.
There we go. 2 questions. Mike, over here, please.
Thank you. Could you say a word or two about other areas of the world in terms of equities, because so much of equity investment, of course, is spread. You mentioned our performance in relation to some European economies in terms of debt, but if you have to plump for other economies, the US or Asia, or any general comments there? India, China?
So we favour Europe at the moment in terms of equities. We've been quite fortunate that they've appreciated quite strongly. And the question is now, are they quite expensive? We don't believe they are. Europe's funny, it's had an earnings-less recovery. Earnings growth has not come through at all in Europe yet. But all the signals suggest, PMIs being one of those signals, that earnings will start to recover in Europe. And across equity markets, Europe's still 19% below. It would have to appreciate a further 19% to achieve its all-time high in 2007, whereas the FTSE 100 is already there. And the same in the United States. It's a funny thing, but the trend in the investment world recently has been for earnings momentum. Where there is earnings growth, you buy those sorts of companies. And we're starting to see a bit of a switch around in that. We still like Europe. In China, it's been, if I was to put my hand up as an investor and say we've been long China, we like China for a couple of years, and it hasn't worked out well for us yet. I think there's a longer-term demographic in China, and that's the reason why we're investing in China. Currently, China has 300 million people deemed to be middle class. So that's more than the whole of the US population. Come 2030, there'll be 700 million people who are deemed to be middle class. We really want to be, we know that's a very important demographic, and we want to be positioned rightly. China equities are exceptionally cheap at the moment. And to your point about the United States, it is quite an expensive market. I suppose in the coming 6 months, it's still a good investment. We'd be a little bit cautious past that because, again, like the UK, interest rate hike cycle is interest rate hikes are likely to start to occur.
Great. One more question. There, I thought there was another hand. Yep. One at the back, please.
I'd just like to return to the issue of Scotland, if I may. The audience in this room seems to think overwhelmingly that Scotland won't declare independence. But the fact is, what will happen if we have Devo Max, which, whether Scotland becomes independent or not, we certainly will be facing, if it remains, as some sort of continuing Devo Max. What impact could that have on the economy of Britain, do you think?
Well, that's what we think Alex Salmond's probably angling for, is Devo Max. Scotland employs 24% of the Scottish population is employed by the public sector. So I don't think it will mean they get greater concessions on, I suppose, decisions for their own political autonomy. I don't think it will have any significant impact on the Scottish or UK economy. I mean, there was the discussion in the FT the other day about the balkanisation of politics within the UK, and that would be a shame if that happened, if we we would see it as a bit of a regression. To put a case in point, Diageo, a Scottish company, has a big issue with selling alcohol to India. Tax rates are exceptionally high for Diageo in India. And if it comes to India as part of the EU, it's ranked at number 1 in the list. But if it comes as the UK or Scotland, it'd be ranked at number 12 in the list to try and renegotiate alcohol tax import duty. So for us, it's quite important that really Scotland remains part of the UK. I think Diageo is a good example of that.
Great. Well, listen, thank you, James. If everybody can show their appreciations for James Butterfill.